Dear student, hope that all of you are doing very well. I am Dr. Sharat Khandaka, and today my topic will be Islamic banking and finance system. So the basic objective of the topic. So the key aim of this topic is to assist student in understanding the theory and practice of Islamic banking based on the contemporary situation. At the end of the topic, students will be able to understand the theory of Islamic banking, understand the operation of Islamic banking, identify the product offered by Islamic banks, evaluate the performance of Islamic bank, and analyze current issues and problems faced by the Islamic banking system. So before starting the topic, let's get some idea about Islamic banking. So Islamic bank provide finance through profit and loss sharing and partnership. So in Islamic bank, it is allowable to do the business through the profit sharing and also start business with the partnership. So investors will receive fixed shares of profit when the occurs. However, this is to note that though the Islamic bank having a history from 1950s, but Islamic history goes back around 14th century. So it's very old tradition. And we have seen there are recent growth in Islamic banks in different part of the world. Specifically, there are more than 50 countries of the world. They follow the Islamic banking system or have some type of Islamic banking system within their economy or the banking system. And there are some large organizations, large banks in the world, such as the Citigroup. They also have Islamic banking in their operation. So the Islamic banking is getting popularity. And the main hub of the Islamic banking system is the Kuala Lumpur, Malaysia, Dubai, and some Middle Eastern countries. However, there are also Islamic banking system which is practiced in other Western world, such as in Australia. There are Islamic banking systems which are already in the place. Basis of Islamic banking and finance. So the basis of Islamic banking and finance includes it emphasis on the mutual consent and consensus among the concerning parties. Now, the Islamic banking system also prohibit any types of excessive risk or uncertainty. So the prohibition comes from cheating and corrupt practices in the management of the fund. That's why it has been prohibited, and it also does not allow dealing with the prohibited product. So, for example, investing in prohibited items such as pork, which is prohibited in Islam, has been forbidden. Investing on interest-related item is also been prohibited in Islamic finance. So what are the difference between Islamic finance and the conventional banking? So one of the biggest difference between Islamic finance and the conventional banking is the riba, or the interest. Or in other words, we can also say it's usuri. Second is gharar, which is excessive uncertainty. So any types of speculation has been forbidden in Islamic finance, and any types of haram activities, or which is called not permissible activities. For example, gambling, dealing with the poor, are haram activities, so which is forbidden in Islamic finance. The second difference is the implementation of the profit and loss sharing principle. So in Islamic banking and finance is based on the profit and loss sharing principle rather than purely based on the profit. It also forbids financing in haram transaction, as I mentioned before, which includes alcohol, gambling, and pork related items. And it also emphasizes on the productivity and the real economic activity rather than just creditworthiness. So these are the basic differences between Islamic finance and conventional banking. So whenever we talk about Islamic finance, the first thing is coming to our mind is about the usuri. So the usuri means, it's coming from an Arabic word which just means the charged or paid on the loan. So, or another way we can say that illegally excessive high rate of interest. So an excessive or illegal high rate of interest charged on the borrowed money, it is called the usuri. So it's an Arabic word. So the prohibition of lending at interest uh, is basically the key promises on the usuri. So that is a transaction that ensures a guaranteed return on one party regardless of the circumstances of other is unfair in Islamic finance. So it's basically suggesting that the party will be given a the party will be given a promise of paying excessive high rate of interest even without knowing that whether the money he's borrowing for the business will generate profit or not. So this is unfair for another party, so it is haram, or it is also called not permissible in Islamic finance. Now the unfairness exists because both parties do not have the same or equal amount of risk. So the basic principle of the Islamic finance is sharing the risk. So if it is a profit sharing, that is permissible, but if it is one party is taking all the risk, which is not permissible. Islamic banking and finance. Under Islamic banking, there are two main fields of financing. One is equity-based financing, and the second is debt-based financing. These modes of financing primarily differ from conventional financing due to their avoidance of the interest. So it's not charging any interest, so that's why it is different from the conventional financing. Now, when we're talking about the equity-based financing, it basically has two different products in Islamic finance. One is called musharika, which is sharing equity or business partnership, or called the joint venture. And second is the mudaraba, which is trustee limited or investment partnership. So we'll look each of this item in our lecture as well individually, and how does it fits with different investors demand. So the first item is musharika, which is sharing business partnership or the joint venture. So in this form of financing, two or more parties come together and contribute fund in a partnership, and the partners share the profit and losses in a joint venture. Now remember, the profit should determine according to the agreement of the partners, but not necessarily according to the capital contribution. So one partner can contribute 60% and another partner can contribute only 40%, uh, and they can still share the equal amount of profit regardless of the capital contribution. Now remember, this could depend on how much each partner contributes to the partnership beyond their capital shares. So how much each partner contributes beyond the capital shares, and how much they contribute physically or improving the business. However, the loss must be determined according to the percentage of one share of the investment. So if there are two different parties or two different partners, one provided 40% and another provided 60% of the capital, but loss must be determined according to the percentage of their own investment. So the person who invested 60%, who should share 60% loss, the another person who invested 40%, that should be he should be bear 40% loss. However, the scholar agrees that equal division of losses accordance with the ratio of each investors. And this is also to mention that the profit return to each partner should be reflected This should reflect the actual profits made by the enterprise as opposed to the set income. So it should be the actual profit rather than the set income they determine at the beginning of the business. So it is based on the profit or loss sharing rather than set up a strict percentage of the profit and loss. Home purchase in Islamic finance. Now, the home purchase in Islamic finance also can be determined or can be explained as the diminishing musharika. So in this method can be used in purchasing the property or the assets such as machinery for factories, or for example you want to buy a house. So the client must provide a significant amount of fund, which is 20% to the purchase of the house with the bank. So the client must go to the bank or Islamic financial institution and apply for the loan. In general, Islamic finance require a high percentage of the deposits, say for example 20% of the purchase price. So in this case, the bank will own 80% and the client will own 20%. However, since it's kind of like a partnership, but the client is using the home or living in this house, the client also need to pay a certain percentage of installment on the top of their own installment to the bank as a rent, which is called izara to the bank for the share of the bank own. So for the bank will 80%. For the client, they will pay 20% deposit, plus they need to pay the rent of using the house because the bank is not using the house or living in this house. And the rent can be determined by the different factors. For example, the rent in that particular area. Rent can be also determined by the size of the house and other factors. And for example, how new the house is and the condition of the house. So for example, it could be 8% of the rent, and that need to be paid to the bank every month. So that will be a contract called izara. Over the time, the client will own more equity in the house until it is completely bought, while the rent will decrease as the bank share is diminished. So as over the time, the rent will cover throughout the period. So the house purchase has been done for 20 years, so the agreement is for 20 years. So over the time, the owner of the house will have more equity in this house, and there will be a decrease of rent over the time as well, because the bank's capital investment is reducing over the year. So this is how a house purchase can take place in Islamic finance. Now there are several institutions in Australia that provide Islamic finance. For example, Makkah, there's an institution that provides Islamic finance. And in Victoria, there are more than 5 financial institutions also that provide Islamic finance. So the second part of equity-based financing is mudaraba, or the trustee or investment partnership. A mudaraba contract is based on a partnership in which one partner is the financer or the investor, and other party is the fund manager or called the working partner, or manage the financial investment in an economic activity. So generally, in these types of financing, the second partner often is the entrepreneur. So he is running the business and has huge expertise of running the business or applying the venture capital into the economic activities. Both parties agree in advance to a profit and loss sharing, or PLS, profit and loss sharing ratio. In Arabic, the investor is called the Rab Emal and the fund manager is called the Mudarib. So let's look at some definitions. So Rab Emal is the owner of the wealth, so who provide the finance, who is investing. Mudarib is the entrepreneur or the fund manager who run the business, and al-mudaraba al-muqayyada is sometimes there are specific restriction provided to mudaraba financing, that where they can invest or where they cannot invest. So another part of financing is called the murabaha, or it's called the sale contract. So murabaha, also referred to as a cost plus financing, is an Islamic financing structure in which the seller provides the cost and profit margin of a commodity. So it is not really a interest-based loan, but it is acceptable form of credit sale under the Islamic law. In murabaha, contract of sale, the client petitions the bank to purchase an item for him or for her. For example, the client need to buy a tractor. So the bank will buy the tractor for the client, and then it will also include some percentage of profit with the cost, and then it will be divided for numbers of years, and the client need to provide the money to the bank, or the client need to provide installment to the bank over the time, so for example for 5 years. So the complying with the client request, the bank establishes a contract setting of cost and profit for the item, which represent typically an installment, or in installment the client will repay the full amount to the bank. So if you look into the murabaha in more closely, let's look at to the slide. So in this slide explain the murabaha or investment partnership. So let's look at in here. So this is investor who will provide the capital, and this is mudarib, who is entrepreneur or who has the business expertise. They will come together and they will create a contract among them to start the business or investment partnership. Now this is the business venture. So for example, they want to open a pizza shop. So the mudarib or the entrepreneur, he has extensive experience of running a pizza shop but doesn't have the money, and the investor is having a lot of money, so he want to invest, and the business venture is the pizza shop. So whatever the profit they will make at the end of the month or the financial year, it will be divided among them with the predetermined ratio. That's what they need to do, and quite often, say for example 50-50. Now we'll talk about the elements of risk in Islamic banks. There are two different types of risks that can be seen in Islamic finance. One is the systematic risk, and the second one is the unsystematic risk. The systematic risk is the risk that arises from the macroeconomic factors such as changes in economic, political, and social issues, business environment, interest rate, inflation, and other factors. As such, it can be hedged but cannot be diversified completely away. So as we know, the systematic risk cannot be diversified completely away from the market, and it will be remain in the market. Unsystematic risk is a unique risk for a firm or an industry. So for the unsystematic risk, we do the diversification. So the diversification can reduce the unsystematic risk, however, it cannot be eliminated completely. Now, the examples of the unsystematic risk are, for example, regulatory action, labor difficulties, consumer preference, loss of key accounting, and the labor strikes. So these are the unsystematic risk. So the Islamic financial institution, they basically face 5 different categories of the risk, or the 5 common types of risk in Islamic financial institution that can be faced in the market. This includes the credit or default risk. Number 2, interest rate risk. Number 3, liquidity risk. Number 4, operating risk, and the number 5, the government risk. So in this lecture, we'll go each of these risks individually and look for the definition of this risk. So the number 1 is credit or the default risk. The largest sources of the serious banking problem is the credit risk, the risk of counterparty default, or the risk of the client will default. The credit risk is defined as the risk that the value of portfolio may change due to the unexpected changes in the credit quality of issuer or trading partner. So that is the definition of the credit risk. Islamic finance is also vulnerable for the credit risk, and the credit risk will go towards its customer. So this could be a significant part of the risk management for Islamic finance. The second part of the risk, or the second types of the risk the Islamic finance can face in the market, is the interest rate risk. Though the Islamic finance derives from the Quran, and Quran forbid the interest, however, the interest rate risk is also arises because of the other factors in the market. Now, as we know that interest rate risk derive from the market because of the changes of the interest rate, and the changes of the similar types of product in the market which are not Islamic finance product but the other product, if the changes of the interest rate in those product happens in the market, that will also impact the Islamic financial product. For example, the price of the bond goes up because of the interest rate down in the market, then how this interest rate risk impacting the product of the Islamic finance, that is the interest rate risk of the Islamic finance. The third type of risk in Islamic finance that can be faced in the market is the liquidity risk. Liquidity risk occurs whenever there is a mismatch between the asset and liability of the bank. Islamic Bank plays a role as an interest-free banking system where there is no interest to be collected or charged as compared to the conventional or the Western banking system. Islamic Bank rely on the Islamic models of the finance that based on the profit and loss sharing, which dominates both sides of the balance sheet, which is the asset side as well as the liability side. As a result, depositors who share the risk with the bank on the liability side absorb any shocks occurs on the asset side of the bank. So liquidity risk is also visible in Islamic finance. The fourth types of risk is the operational risk. So the operational risk is the non-compliance with the Sharia rules that is referred in the Sharia risk. So the operational risk is basically not compliance with the rules and the regulations of the Islamic banking product. So this can be included in operational risk as a non-compliance lead to the reputational damage of the industry and the product, which can trigger an exodus of funding from the Islamic investors, causing failure and the systematic risk. For example, if the Islamic financial product found that it doesn't fully comply with the Sharia rules or Islamic financial rule, and how the market will react, that will be coming under the operational risk. The fifth and the last risk of Islamic financial product or Islamic banking is the government risk. So the government risk arises from the changes of the regulation, changes of the government system, introduce new legislation, and so on. So these are the risks that the Islamic financial institution and Islamic bank that can face in the market. So next slide, we'll talk about the Islamic banking and the conventional banking system. So what are the main difference between the Islamic banking system and the conventional banking system? First, Islamic financial institution can be riskier than the conventional banking institution due to several reasons, including a specific nature of the risk and unlimited number of ways to finance a project using either the profit loss sharing or the non-profit loss sharing contract. So this way, because it is based on the profit sharing or non-profit sharing or loss sharing contract, because it's fundamentally different from the other banking system. Second, and the second point is Islamic financial institution may be more vulnerable to unfavorable event than the conventional financial institutions. Because because of the interest rate factor, Islamic financial institution, they do not go to the money market, or they do not have sufficient product to go to the money market, which is a liquid market. So it is always having some disadvantages than the conventional banking system. Second, scarcity of hedging instrument, underdeveloped interbank money market, and a market for the government securities which Sharia compliance. Or Islamic financial institution may be more vulnerable to unfavorable event than the conventional financial institution. Third, uh, its inability to utilize money market. Because the Islamic financial institution cannot go to the money market, therefore it can certainly suffer from the liquidity risk. And the last point is, for the Islamic financial institution, liquidity risk can be considered as one of the most critical risks due to the certain factors such as limited liability of Sharia compatible money market and interbank markets. So they do not have equivalent product to go to the money market or interbank market. Second, shallow depth of secondary market for Islamic financial instrument. And the last point is the problem of lender as a last resort for the central bank, because Islamic financial institution, they normally do not go to the central bank for the liquidity problem. So these are the major risks that's faced by the Islamic financial institution. Hopefully you like the lecture for today, and this is the last slide of the lecture. If you have any question, please send me an email regarding this chapter, and thank you very much for watching this lecture today.